Hello and welcome. My name is Kathleen Levito, Marketing Coordinator with AAFMAA, which stands for the American Armed Forces Mutual Aid Association. We're excited today to have you join us for this AAFMAA Mortgage Services webinar about down payments. But first, a little information on the association. AAFMAA is the longest standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of affordable life insurance, expert investment management, and customized residential mortgages, and exclusive survivor assistance services, all for the military community, not for profit. As a reminder, this presentation is educational. It's for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your mortgage decisions. For individual advice, please contact us directly. Today's presenter is Denver Branch Manager, Mark Wendler. Mark manages one of AMS's newest branch offices in Denver, Colorado. Mark has been involved in the mortgage industry for over 23 years. All right, Mark, handing over the presentation to you.
Thank you, Kathleen. Hi, everyone. As Kathleen mentioned, my name is Mark Wendler, and I am the branch manager for the Denver AAFMAA Mortgage Services branch. I've been in the business a very long time, so I've got a lot of knowledge and experience to share with everybody. Anything related to real estate and mortgages, me and my team here in the Denver branch are an excellent resource for everybody to reach out to, ask questions. We can take a deep dive into what your situation looks like and how we can help you. So let's go over the agenda items that I'm going to talk about today. There's a lot of different terminology, acronyms, and a whole lot of information that exists within buying a house and the mortgage industry. So I'm going to try and provide everybody a little bit of clarity in regards to some of this information. And whether you're a first-time home buyer and have no experience with buying a house, or whether you have owned a home in the past, there's always additional questions and always additional information that can help you if you decide to go down this road again. So the agenda items for today that I'm going to be covering, first one is going to be the different loan types. And does that loan require a down payment? There are different loan types that we're going to discuss, and I'm going to give you a brief overview of what each loan type is and what the qualification requirements are. And then we'll talk a little bit more about what the down payment requirements are as well. And then second item, what is PMI? Again, going back to, there's a lot of different acronyms that exist in the mortgage industry. And we're going to talk about PMI, which stands for Private Mortgage Insurance, when it's required, why it's required, and how to avoid having to pay it if at all possible. What is a down payment? This one sounds a little self-explanatory, but there are some specific details that I want to cover when it comes to the different loan types and how much money you'll have to come up with if you do decide to purchase a house. What is DTI? That stands for debt to income, and we'll talk a little bit about what is the qualifying requirements for your debt to income and how lenders look at that. And again, going back to what different loan types, what the different requirements are for each loan type. And then we will also talk about the pros and cons of the various loan types and how much you come up with for a down payment for each loan as well. And then finally, we will talk about, or I'll open it up to some questions that are out there. And hopefully, if you've got some questions that you want to share with me and I can answer for you, I'll be happy to answer them for you. Okay, so let's go over the first slide here. Does my loan require a down payment? And this is going to depend on the different loan types that exist out there. And I want to just give a brief overview about each different loan type. So the first one is going to be FHA. The minimum down payment required for an FHA loan is going to be 3.5%. And when we talk about the percentage, I mean, that's just based upon the purchase price of the house. So in easy numbers, if you're buying a $100,000 house, the down payment requirement for an FHA loan would be $3,500. Obviously, the higher loan amounts are going to come with a higher requirement for the down payment. But in terms of an FHA loan, the qualifying requirements are different compared to, let's say, what we call a conventional or a VA loan. FHA stands for Federal Housing Administration. It's a government-backed loan. That loan type is generally going to cater to individuals who maybe have less of a down payment, may have a few issues in terms of their credit, and maybe they've got some difficult to prove income. So all of those things get factored into whether an FHA loan is going to be your best option when it comes to buying a house. But it is a way for people to get into homes, and it does help quite a few people in terms of getting into their first home. One of the things we will talk about in one of the slides ahead is the requirement for mortgage insurance, and FHA loans do require mortgage insurance with their loan types. But in terms of the down payment and qualifying requirements, minimum down payment requirement for an FHA loan is going to be 3.5%. The second loan type that I want to talk about is a conventional loan. And so on a conventional loan, the minimum down payment requirement for a conventional loan is going to be between 3 and 5%. But more often than not, you're looking at a down payment requirement of 10 to 20%. And again, until we actually dig into your individual financial situation, that's going to give us a better idea as to which loan type we want to look at and what's going to be best for your financial situation. Conventional loans compared to FHA, this is going to be your good credit, good income, and if you've got a substantial down payment, the conventional loan type is going to be a good option for us to look at for you. So usually we're looking at credit scores. On a conventional loan, credit scores between 680 and 800 or higher. And again, the stability of the income always comes into play with a conventional loan. So depending upon your individual financial situation, we'll see which one's going to make the most sense. But conventional loans are always going to be kind of your top tier as far as qualification. The third loan type is going to be your VA loan. And this one is one that we offer quite often to our military veterans and active service members. And it's a great way for our veterans and service members to buy a house, because VA does allow for no money down to be offered on that loan type. And there are some specific qualifying requirements for the VA loan, but whatever the purchase price is, for example, on a $300,000 purchase price, we can lend up to $300,000. So it's 100% financing where there's no down payment requirement. Now, again, we will take a look at your individual financial situation to make sure that you're eligible, but it is a great way for you to purchase a home and use the benefits offered by the VA. And just to be clear, when we talk about no money down, there's always going to be some money that's required at closing. So there's always going to be the requirement for some closing costs. There's also a requirement for homeowners insurance and property taxes, which we will discuss on an individual basis as far as a loan or a home that you're looking to purchase. But it is a great way to minimize the amount of out-of-pocket money that is required for you to get into a new house. Now, I did want to make reference to that little blurb at the bottom of the slide here. So to be eligible for a VA home loan, you or your spouse must meet the basic service requirements set by the Department of Veterans Affairs, have a valid certificate of eligibility, and satisfy the lender's credit and income requirements. So again, that's where an individual conversation with us to talk about your individual financial situation and your eligibility for the VA benefits will determine if you're going to be eligible for that VA loan. Okay, so let's go on to the next topic that I want to talk about, which is what is PMI? PMI stands for Private Mortgage Insurance. It is a type of mortgage insurance you might be required to pay if you have a conventional loan. Like other kinds of mortgage insurance, PMI protects the lender, not you, if you stop making payments on your loan. When you have PMI, you'll need to pay an extra fee every month in addition to your mortgage, principal, interest, property taxes, and homeowners insurance. Your loan documents may also indicate that you'll be able to stop paying PMI, usually when you build up equity equal to at least 20% of your home's value. So I want to talk a little bit more about this in greater detail because private mortgage insurance is very confusing for a lot of home buyers out there. So I want to provide some clarity when it comes to the different loan types and what is required. So on a conventional loan that we had talked about on the previous slide, that's usually where if you put 20% down on any house, there is not a requirement for mortgage insurance. And a lot of lenders emphasize that. So again, if you've got money in the bank or money saved up that you can put towards the down payment so that you're only financing 80% of your purchase price, there's no requirement for mortgage insurance to be included. However, if you put less than 20% down, lenders do have a requirement for PMI or private mortgage insurance. The interesting thing to note about mortgage insurance, I mean, in my experience, whenever I've paid for insurance, that usually insures me against some type of loss. And this is what's a little confusing in the mortgage world or the lending world, is that if you pay private mortgage insurance, you're not insuring yourself for anything. You're actually insuring the lender in case you happen to not be able to afford the mortgage payment anymore, and you end up going into some type of a foreclosure process. Obviously, we're not looking to make that happen, and this is where we do a deep dive into your financial situation to determine your eligibility for each loan type. But when it comes to private mortgage insurance on conventional loans, that is the reality of what that is. So all that is it's an extra cost that does get added into your monthly mortgage payment that we do factor in, and it insures the lender in case you, again, were to default or fall behind on your mortgage payments. And again, if you can avoid having to pay mortgage insurance, it is strongly recommended. So if we are ever looking at a conventional loan and you're looking at purchasing a house, a 20% down payment will allow us to avoid that mortgage insurance requirement. Less than 20%, that will be factored in. In terms of an additional amount added to your monthly mortgage payment, you can expect somewhere around, I mean, I always give people an estimate of between like $30 and $70 per month. It is based upon the credit score, and it is based upon the down payment that you put towards the house. In the middle of that, you can assume maybe about $50 that would be added to your monthly mortgage payment. Now, the one thing I definitely emphasize is when it comes to the VA benefits and VA loans, this is one of the best parts about the VA loan, is that not only is there no requirement for a down payment, but also mortgage insurance does not apply. So if you do go with the no down payment on a VA loan, your monthly payment is simply going to be your principal, interest, property taxes, and insurance, which is a fantastic way to avoid that requirement. So I wanted to talk more about mortgage insurance and give you the basic understanding and let you know that it can be avoided altogether if you qualify for our VA loan. So whenever you're talking to us, whether it's myself or someone on my team about the different loan types that you're eligible for, this is going to be the things that we are going to look into, is what loan type is going to fit best for your situation and what's going to be the least expensive. If we can eliminate the requirement for the mortgage insurance, I'm all for it. And that's where that individual consultation will kind of uncover what's going to work out best for you. So I'm not going to go into too much more about this, but I just wanted to make mention of, so on that other loan type that we talked about, FHA, there is mortgage insurance that is required on the FHA loan type. It's a little bit different than the mortgage insurance that is required on conventional. And more than likely in our conversations that we have about your eligibility to buy a house, the two loan types that we would be focusing in on the most are going to be either in a VA loan or a conventional loan. So I'll save the details about mortgage insurance on FHA for a future webinar. All right, so let's go on to the next topic, which is what is a down payment? And we'll talk a little bit about the different loan types as well. So, okay, so bullet point number one, how much should I put down to buy a house? So everybody's going to have a different financial situation, and everyone's going to have a different credit history, stability of income, and money available in the bank. So when it comes to how much should I put down on a house, I mean, that's really going to be an individualized conversation. But what I can say is that with the VA loan that we do offer here, if you don't have a whole lot of money to put towards buying a house, you still are going to be in a great position to purchase a house. Now, the one thing to keep in mind is the more you put down on the house, the less you have to borrow, which is also going to have an impact on your monthly mortgage payment and how much you can afford. But when it comes to how much should I put down on a house, we're going to talk about it in our conversations. Since money is so cheap to borrow right now, interest rates are very low. I always recommend holding on to your money as much as possible. So if you can save that money or keep it in the bank, and instead of putting it towards the down payment, that's always going to be my first recommendation. But again, when it comes to your individual financial situation, that's where we're going to talk about it and find out what works out the best. Bullet point number two, is it worth it to put more down and finance less? So again, we have a target monthly payment that we're going to be comfortable with. We know what we are currently paying for, whether it's rent or maybe we already own a house currently and we know what our monthly payment is. We know what our income is. So when it comes to having that conversation with myself or somebody on my staff about your situation, we're really going to dig into the numbers and kind of make sense of what it is that you're going to qualify for. If you're comfortable with putting a down payment, we can look at that and we can give you a quote as far as what your monthly payment is. We'll give you an estimate of what your property taxes and homeowners insurance is going to be. Some of the other things that we always have to take a look at is, does the property that you're looking to purchase, does it have an HOA requirement? Is it part of an HOA? How much are the HOA dues? What we want to do is really dive into all of the expenses that you can expect as part of your mortgage payment and determine like what is going to work out best for you. So whether that is coming up with a substantial down payment and financing less, or coming up with less of a down payment and financing more, we can give you those options and really determine the best case scenario for you. What are the benefits of putting more down to buy a house? If you're putting a large down payment down, that means you're obviously financially well off, or at least have been saving up for a period of time, and you'll be financing less and you'll have a lesser down payment. So we will definitely take a look at the different loan types that we can offer to you. We can give you quotes and estimates as far as the monthly payment, and you can kind of give us the feedback as far as what you're targeting and what you're looking for, and we'll be able to tell you whether that's something that is something you'll be eligible for, and then we work together in terms of finding out the best options that are available to you. And then the last bullet point, is a down payment considered equity? The answer to that question is yes, with an asterisk next to that. The one question I get quite often in this business or in this industry is, where do you think property values are going to be 5 years from now? And that quite simply cannot be answered because I have absolutely no idea. Whenever I'm talking to somebody about buying a house, it's really about their current financial situation and what their income is, their confidence level that that income is going to be sustainable, and whether they can afford a monthly payment. So is a down payment considered equity? The answer is absolutely yes. But where property values go in the future, that's to be determined by the markets. What I will say is that over time and historically speaking, owning a house has always been a good financial investment, and property values tend to go up over time. I don't see any change to that going forward. It's the American dream is to own a house. As you pay down the balance of your loan and as property values either remain stable or go up, you do build up equity. But when you first buy a house on day one, that is absolutely equity in the house is the down payment. So, all right, let's go on to the next topic. What is DTI? DTI stands for debt to income. It's a lending term which describes a person's monthly debt load as compared to their monthly gross income. Mortgage lenders use debt to income to determine whether a mortgage applicant can maintain payments on a given property. DTI is used for all purchase mortgages and for most refinance transactions. Okay, so here's an important topic that we always discuss whenever we're looking at getting somebody qualified for a house. So what we do as loan officers or military mortgage advisors here at AAFMAA Mortgage Services is we find out what your current debt load is based upon whatever appears on your credit report. So that's going to include things like car loans, credit cards, student loans, installment loans. Whatever money you have borrowed from a financial institution is going to show up on your credit report, and that's going to reflect a monthly payment. And what we do is we're going to add up all of those monthly payments together to give us basically what your income is. Now, we don't factor in things like utilities. We don't factor in cell phone bill, cable bill. Those are items that we consider discretionary to a certain extent and are not really going to be factored into the equation when it comes to getting you qualified for a mortgage payment. What we do is we're just going to look at everything on the credit report. And that's where it comes into play as far as the new monthly payment that we can get you qualified for. Because we're going to factor in a monthly payment based upon the loan amount. And then we're also going to factor in the property taxes, homeowners insurance, and the homeowners association dues if that is in fact required. So then we add up everything on your credit report. We add up the estimated new monthly payment on the mortgage. And this is where we are going to do a deep dive into your monthly income. And again, everybody's got a different financial situation when it comes to their income. And so whether you're retired, whether you work a job, whether you receive Social Security or pension or disability, doesn't matter what your income is, we're going to add up all of your income that is coming in on a monthly basis. And then we compare that against all of the debts that you have on your credit report and the new mortgage payment. We come up with what's called the debt to income ratio. So again, this is a mortgage lending term, but this is something that we will talk extensively about in a one-on-one conversation whenever we're looking at getting you pre-qualified to purchase a house. Now, as far as the different loan types, this is again where I talk about the differences between a conventional or a VA loan, because conventional loans, and if you remember from a previous slide, we talked about how this is going to be your top tier of financing, where you've got excellent credit, potentially a substantial down payment, and you've also got good income. On conventional loans, it does have a specific debt to income ratio, which is going to be between 43 and 45%. So again, making the math simple on this, if your monthly income is $1,000 per month, the maximum amount that you would qualify for on a conventional loan for a conventional loan would be $450, which is 45% of your gross monthly income. I don't want to make things too complex, and quite honestly, a lot of people are going to be looking at larger purchase prices than $100,000. I'm just trying to keep the math simple there. But conventional does have specific debt to income requirements that we have to look at. Now, it's a little bit different for a VA loan, because VA doesn't have a specific debt to income ratio requirement. Actually, for VA loans, it really doesn't have any specific amount. We basically are going to gather in all of your income. we're going to calculate all of your expenses and run it through our system. And if our automated underwriting system takes a look at it and determines that you are eligible, that means that we can get you approved for that particular VA loan, or we can get you approved for 100% financing on that purchase. So it makes it a little bit more attractive to go down the path of getting qualified for a VA loan, simply because it does have less stringent debt to income ratio requirements. So again, going into the different loan types, we'll take a look at your individual financial situation and see which one makes the most sense. All right, so then let's go on to the next slide. DTI Common Questions. Based on my DTI, how much home can I afford? So this is going to be a very individualized answer for everybody. Basically, what we'll do in our consultation when we talk is you'll give me either a ballpark figure or an exact amount of what you make on a monthly basis. And we can also look at what your expenses are. And I'm going to be able to give you a real close idea as far as what the maximum amount is that you qualify for. But ultimately, it's going to be your decision, because you're going to want to make sure that that monthly payment is something you're comfortable with. One thing I often talk about with customers is you never want to be house poor, meaning you don't want to have to spend all of your monthly income on a mortgage payment. You're certainly going to want to leave some money left over for discretionary items, going out to eat, groceries, gas. Again, we talked about cell phone bill, utilities. You always want to have some type of money left over. Owning a house is a big responsibility, and quite honestly, there are going to be some additional expenses that pop up. If you've got a furnace that needs repairs, that's not something that can go very long if you're experiencing some sub-freezing temperatures at night. So, how much home can I afford? Very individualized question that we're going to take a deep dive into on our conversation. What DTI limitations will I have to get my loan approved? So depending upon the loan type, for conventional, we're going to look at a maximum debt to income ratio of between 43 and 45%. I should mention there are always exceptions that can be made higher than that. So, but conventional loans, they do have kind of specific debt to income ratio requirements. But when it comes to a VA loan, that's where, as long as we get our system to take a look at your overall situation, and if it gives us an approval, you're going to be eligible for that VA financing, and we will we'll talk about what that monthly payment looks like. And then number 3, how will my down payment impact my DTI? So this goes back into, obviously, if you're financing less, your monthly payment's going to be less than if you're coming up with no down payment and financing the maximum amount of that house. So it all depends upon what monthly payment you're targeting and what you're eligible for. So in our conversations, we will talk about both options, what money you have available to put towards that down payment, and what your monthly payments look like, whether you put a down payment towards the house or not. Okay, and then let's go to our last topic. What are the pros and cons to using a down payment? Okay, so on the pro side, we'll cover that first. So lower your VA funding fee. So something we haven't talked about yet, but does apply to VA loans, is there is a requirement for a VA funding fee, which is going to be automatically financed into the new loan. And it's simply a requirement that the VA has, and it goes directly towards qualifying for the VA. It's not additional money that comes out of pocket or anything. It just gets financed into the loan. If it's your first time using your VA benefits to purchase a house, the percentage of the loan amount is going to be 2.3%. So again, using easy math, if you're buying a house for $100,000, the VA funding fee would be $2,300 that would get added or financed onto the loan to go towards that VA funding fee. If you have used your VA benefits in the past, then your VA funding fee is going to be 3.6% of the loan amount. So again, easy math, $100,000 purchase price, you're going to have $3,600 that gets added on to that. Now, if you come up with more of a down payment, the VA funding fee can get less than the percentages that I just gave to you. So it would be a lesser amount that would get added on to the total purchase price for the VA funding fee. So this is where if you do come up with a down payment, you would end up having less of a funding fee factored into the equation. The second thing on the pro side, saving on monthly payments. So again, going back to the larger the down payment that you come up with, the less that you have to finance, which ends up with a lesser monthly payment. That can be a benefit to you, but until we know exactly what your financial situation is, that will tell us a lot more about which loan option is going to be best and how much of a down payment we think is going to work best for you. Start building equity faster. So as we talked about on a previous slide, the down payment is equity. On day one that you own that house, whatever you've come up with for a down payment, that is automatically equity in the house. And as you pay each mortgage payment, although it's not much at the very beginning of the term, there is a portion that gets applied towards principal with each payment that is made. So as you continue to make every mortgage payment every month for the entire term of the loan, there is going to be a portion of that payment that pays down the principal balance. And it's always nice to see that balance go down. And then you may get an update, or you may be searching online at the various websites that provide property values, and you might see that your property value has gone up. And so then you take your property value and subtract out that current mortgage balance. And of course, that's equity that you have in the house. And of course, over time, you can always use that equity to your advantage. All right, so let's talk about some of the cons on the down payment. It can wipe out your cash reserves. So again, everybody's got the different amount of money that they have saved up to purchase a house. If you are coming up with a substantial down payment, that's coming right out of your checking, your savings, might be your retirement account or another asset account like stocks or bonds. Is it better for you to dip into your cash reserves, or is it better for you to hold on to that money and then just include that into the new loan? Again, everybody's got that different financial situation, which we will take a look at all options and present the best one that we think is going to help you out the most. And then the other one, you just haven't saved enough. I mean, buying a house today is a substantial investment. It is not for the faint of heart. It requires a lot of money to come up with if you do want to save up for that down payment. It requires discipline. Everybody's got different expenses and different things that they spend money on every single month. How much money is left over after all of that, after all those other items are paid for? We take that into consideration, and we really want to talk about what is going to work out the best for you in terms of how much money you have saved up, whether it's best for you to use that money to put towards the down payment, or do we want to look at a loan option that's going to keep your money in your bank account and go with that loan option. So that is a brief breakdown of the pros and cons of a down payment. But I look forward to speaking to all of you a little bit further about your situations and which options are going to work the best for you. All right, so I've covered a lot of topics here. So I would imagine we probably have a few questions that some of you may have. So if you do have a question, you can reach out or type it into the chat box now, and we'll go over a few questions here. So Kathleen, I'll turn it back over to you to read off any of the questions that are coming in.
Great, thank you, Mark. All right, the first one I see here is, if I don't have enough funds for a down payment, should I still purchase a home using a VA loan?
Yeah, so it's going to be based upon everyone's individual financial situation. And the VA loan is my favorite loan to get people qualified for, and it's simply because it does allow for people to hold on to their money and keep it in their checking or savings account instead of coming up with that money for a down payment. So if you've got stability of your income and you know that money is going to continue to come in and you can afford the mortgage payment, that's certainly an option that we can look at. I can't say definitively or kind of broadly that that's going to work out for everybody, but on the VA loan, if you qualify for 100%, on the VA loan, it might be a good idea to just go after the full 100% and hold on to that money. But again, it'll be different for everybody.
All right, great. So the next one is, do you foresee rates staying consistent over the next few weeks?
That is a common question that I get quite often. And so I think I brought this up earlier on in this presentation. So there's two questions that I don't have, or that I don't have the capabilities of answering, and that is where a property value is going to be in the future, and do you know where rates are going to be at in the future? I get that all the time. I have absolutely no idea what's going to happen with mortgage rates. Since I've been doing this for 23 years, I've seen a big fluctuation in mortgage rates from as high as, I mean, quite honestly, I've seen rates as high in the 5s and 6% back in the late 90s. And then, of course, within this last year, we've seen rates as low as 2.25, and they remain low right now. So what I always tell people is don't necessarily focus on the interest rate, focus on the monthly payment and your stability of your income. Mortgage rates are going to fluctuate going forward, and that's just a given. So if they do happen to drop after you purchase the house, there's always going to be an opportunity for you to refinance to a lower rate in the future. But as far as you qualifying to buy a house right now, it's really going to be based upon your income and the monthly payment that we're looking at for your new house payment.
Okay, thank you. So the next one is, will my lender let me know when I don't need to pay for PMI?
That is an excellent question. So when it comes to PMI, as we talked about, as it pertains to conventional loans, so if you put less than a 20% down payment on a conventional loan, and there's a requirement for mortgage insurance, there's going to be a document that's signed at closing, which gives you a date as far as when that mortgage insurance is going to fall off. Now, when it comes to conventional loans, it's based upon the document that gets signed at closing makes it so that your balance has to be 78% of whatever the purchase price is. That's the point that the mortgage insurance automatically falls off of your mortgage payment. However, and here's a little trick or a little inside information, if you are paying mortgage insurance on your monthly mortgage and you have a conventional loan, you can call your lender when you have that 20% equity. So whether that is 20% of the purchase price, or if you have seen property values increase, you can call your lender. The lender may require you to get an appraisal done to confirm the current market value of your property. But at the point that your loan to value is 80%, the mortgage insurance can come off of your monthly mortgage payment. But as far as your lender letting you know, it does automatically fall off, and there will be a document signed at closing to confirm that.
Okay, let's take a look at another one. How can I prove my DTI, and why is this so important?
So improving your DTI is strictly going to be related to your income and your current monthly expenses as reflected on your credit report. So depending upon your current debts, that's really going to be the main factor that I think you would have an opportunity to improve your DTI. Now, having said that, I mean, your income is your income. Depending upon what your current income is, whether that's going to increase or whether that's going to remain stable, that's to be determined, and that's something that we can certainly find out. But as far as improving your DTI, if you have credit cards that you can pay down the balances on, or if you have a car payment that is close to being paid off, you can certainly pay that loan off. And then if that payment is not reflected on your credit report, or we can at least prove that you are no longer required to make that payment, that means that you can qualify for a higher purchase price, because we no longer have to factor in that payment into your current monthly expenses. So that just means that you would qualify for a higher purchase price or higher loan amount. So yeah, that would be the main thing that I would consider to be the best way to improve your DTI.
Okay, let's take a look at one more question. How long is the application process, and what about the approval process?
Great question. And yep, so the application process, so we can get somebody pre-approved, and we can really dive into the numbers in terms of how much you can qualify for. That does not take long. So we, within a 24 to 48 hour period after we talk to you, gather some information, gather some documentation in terms of your income, and look at your credit, we can determine how much you are eligible to either purchase or how much you're eligible to borrow. Again, going to the fact of everybody's got a different financial situation, but in a very short period of time, we can determine your eligibility. So if you're anxious to start the home buying process, if your lease is coming up, if you're ready to dip your toe into the world of home ownership, it does not take long for us to get you pre-approved, and we can issue a pre-approval letter in a very short period of time. Now, about the approval process, so that is, I mean, as far as getting your loan approved, once you go home shopping and you determine a house that you want to purchase, once you have an accepted offer, meaning you've submitted whatever it is that you want to buy for the house and the seller of the house has agreed on that purchase price, once that's accepted and you submit that contract over to us, we generally need about 35 to 45 days in order for us to process your loan and get it closed. So, and that's pretty standard across the industry in terms of time frames. So once you have the accepted offer, you should expect to be closing on that house within a month to a month and a half. And obviously we'll push it through as fast as possible. But the nice part is that we make sure that we have you qualified and pre-approved for that loan prior to you going home shopping. And that gives not only the seller the confidence that you're an eligible buyer, but you'll know that once you do have the accepted offer, you're going to be a homeowner within that month to month and a half process. So.
Great. Thank you so much, Mark. We're going to go ahead and break here for now. But if you have any further questions, please feel free to reach out to us. You can reach out to Mark directly with the information here on the screen, or for general information, go to afma.com/mortgage. And you can reach out to either Mark or another MMA through there as well when the time comes. Thank you again for joining us today, and we look forward to our next opportunity to assist you.